All right, we have a bellwether of sorts here. Salesforce dropped more than 20% after reporting earnings. We should talk about the state of SaaS, software as a service, if you're not in the industry. Salesforce had its worst day in the markets in nearly 20 years on Thursday, and that's when we tape this. They lost about $40 billion in market cap, or as we say in the industry, two figmas. On Wednesday, Salesforce missed Q1 revenue estimates for the first time since 2006. Revenue was up $9.1 billion, 11% year over year, but about $40 million below Wall Street expectations. So they're doing great, but Wall Street is concerned for a reason. We'll get into what that is. Net income was $1.5 billion, 7x year over year, because they've been doing a lot of cuts over there. Free cash flow, $6 billion, up 43%. Profits are up huge because if you remember, those activist investors came in and had Benioff really rethink the structure of the business and the footprint of the business. But guidance for Q2, down. Salesforce projecting 7% growth, relatively low for them. Freeberg, you and I were talking about this. Like, what are your thoughts here on what's happening in the markets? And then we had the side discussion, which we didn't dock it, but I think it's worth bringing up here and dovetailing, which is it does seem like the consumer, which this is an enterprise story, but the economy is cooling off. Consumers, I think, are running out of money. The YOLO economy is finally, I think, at its end. What does this say to you, Freeberg?
Well, I think the key question to your point is there a macroeconomic reason for a slowdown in their business? They're forecasting for this next fiscal year revenue growth of only 8 to 9%. And for this next quarter, it's basically a flat revenue quarter relative to the past quarter. So for this fiscal year, $38 billion of top line revenue, $9 billion of operating cash flow. And with the market cap coming down by 20%, the stock's at a $200 billion valuation. So it's trading at, call it roughly 20 times their operating cash flow forecast with sub 10% revenue growth. And that's basically where treasuries trade, right? Because treasury yields for a 30-year treasury, you can get 4.7% today.
Yeah, I was about to say almost 5.
That's about 20x, right? So that's about where the multiple is on this Salesforce stock. So I think it really begs the question on, is there a macroeconomic force where the enterprise is spending less because of a revenue slowdown in the economy, which we saw in the latest GDP report? That's number one that could be driving this and will affect ultimately the multiple for all these enterprise SaaS companies. Or number two, is there a shifting underway in the SaaS business model that the premium that SaaS companies were able to charge and the pricing model on a per seat basis and the dollars that they're able to charge per employee or per user is so significant relative to what that enterprise can build themselves now with the commoditization available to them under this new era of AI and the ability to build tools internally or the ability for competitors to emerge with significantly underpriced alternatives because they can use generative AI to make software that can compete. And then there's this other question because Salesforce has been leaning in heavily on the generative AI capabilities that they're offering their customers. And it seems like the question is, are enterprises waiting to see the value of that generative AI service capability? Is it worth paying for today? Should I wait and see? Or is it actually indicating that there's a big commoditization in generative AI underway?
Okay.
Meaning, why do I have to pay Salesforce a bunch of money when I can use some open source third-party tool or some more freely available tool?
So Chamath, Freeberg presented two options here. One of them, macroeconomic slowdown. The other one, hey, software, belt tightening is happening inside the enterprise and it's cheaper to make. So maybe we have a deflationary kind of situation inside companies. I guess this is adjacent. That last part of his theory is adjacent to the 80-90 mission you're on with your new startup. And maybe is this an or an and in your mind, Chamath? Is it both these things?
But sorry, before you answer, the third point I made was that generative AI itself,
yes. And the third point,
it may not be a product line. It may not be enough to charge for given all the open source tools out there.
Yes. And there's a big question mark about the AI new software. Will people pay for it? So Chamath, take those three. What are your thoughts?
I think that if you look at what happened before, we had a cycle where very large monolithic software was replaced by these SaaS vendors, and Salesforce led that charge, and they led in many ways, the definition of the cloud. So that was amazing. That was this one big cycle. And before that, those monolithic software vendors were replacing like mainframes and very archaic stuff. This is sort of this third disruptive cycle. we're going to go through a process of ripping and replacing these legacy products. And so Gen AI is just an enablement layer that allows you to deliver functionality to people. And I think what you're going to find is that it allows you to deliver that functionality at much, much cheaper. To your point, that's the whole point of 80/90. And we always joke, is Salesforce going to get 80/90? Yeah, because you can deliver 80% of the features at a 90% discount pretty easily today. And what you can't deliver today will get much, much easier in a year and 2 years and 3 years, for sure in 10 years. So I think what the market is voting with their dollars is that these large, lumpy, monolithic software companies that need big $50, $100 million customers, they're not going to find them soon, because those customers will realize that you could get, what Freeberg said, what you need for 10 million or 5 million or 1 million or 500,000, and in some cases free. And so the cost structure of your organization makes no sense. And so you're going to have to go through this very complicated cycle of recycling, the business model, which unfortunately will mean tons of layoffs. And that's not a today thing, but over these next 5 and 10 years, that's probably what's going to happen. And it doesn't mean Salesforce is a bad company. It's just that it is on the wrong side of the life cycle. And the odds are overwhelmingly such that a bunch of small companies will flood this opportunity and provide cheaper, smaller, more flexible capabilities.
Sachs, obviously, you made your bones in the SaaS business over the last 2 decades at least. What are your thoughts here on the challenges? I just interviewed Owen McCabe from Intercom, and he says he thinks the seat model is going to change. And obviously, if there's less people at companies, there's less seats. And that may be a headwind that you just can't win against. So maybe a consumption model has to happen, or a different pricing model. But what are your thoughts on what's happening at Salesforce? And then open the aperture there and tell us what you think is going to happen in terms of how corporations either decide to make that, build or buy decision.
Well, I think it's pretty amazing that Salesforce lost something like 40 billion of market cap because of a revenue miss of 40 million. It's amazing how these relatively small, in percentage terms, misses in revenue or earnings drive such huge changes in market cap.
It's quite a ripple, isn't it?
Yeah. I mean, look, my view is that I don't have a strong view about the stock, but my sense is it's probably a buying opportunity. I mean, I think Salesforce is still a great company. Mark Benioff's a great CEO. He's always positioned the company to chase after whatever the current thing is. So obviously, he was one of the first to realize that software was headed to the cloud, evangelize for the cloud. Then when the social networking revolution happened, he launched Chatter, which was a competitor to my product Yammer back then, but he was ahead of the curve on social in the enterprise. Then it was big data, and they launched Einstein. Now they've got AI, and they're going to be doing a bunch of different things there. So my guess is he's going to figure out how to take advantage of this AI trend for the company. They're not going to miss it. They're not going to get caught totally flat-footed. So look, I don't have a super strong point of view on it as an investment, but
what
I
about
still
the
think it's
bigger
a good
picture?
company.
Open the aperture there with
I think
SaaS
the bigger
versus
picture,
and pricing, and how many people will work at these companies, and then if the per seat model is the model, and then people are going to have less humans working at companies and do more with less. What does that mean for SaaS writ large?
I'm honestly not worried about the per seat model. I mean, the point of a pricing plan should be to align revenue expansion with ROI, meaning the more value that a customer gets from your product, the more they're willing to pay. And you just need some proxy for measuring that. Seats are a good proxy. It's a good way to measure how much value the customer's getting out of your product, because the more seats they're buying, the more value they must be getting. Yes, you could do it some other way. You could basically meter data usage. You could meter API usage. Sure. Those models will work for other kinds of companies, but I don't think there's going to be a huge disruption to the seat model, is my sense. Look, I think the bigger issue here is that their forecast was soft, right? They are forecasting sub 10% revenue growth.
They're going
and this is why the stock got punished. And I'm seeing that a bunch of SaaS companies are kind of hurting today now in the wake of this. They're down like 5%, not 20, but so I wonder if what the market is wondering is whether there's a more general slowdown that we're on the precipice of.
I don't think that explains 40 to 20% drop in a day. I think typically these public market investors internalize a bunch of fears and they don't execute on those fears. And then when given an opportunity, they just barf it all out because it's like now it's acceptable. And so to your point, David, like it was such like an insignificant revenue miss so as to not even be important, quite honestly. But the reason it's down 20% is I think folks have internalized a different set of risks and then they've found an escape hatch where they have plausible deniability for selling. That's just what a lot of public market investors do.
I don't think it's a coincidence that we just had the GDP forecast revised down for the latest quarter. What was it? It's down to like 1.4%.
One something, yeah. We talked about this last week because this number's fake. That
the economy is looking pretty soft right now.
Which is, I guess, a good jumping off point, which is what do we think is happening here with the economy and then interest rates? Because the whole goal here was to get us under, get us close to 2%, get rid of the 3 handle at least in terms of interest going up and maybe get the consumers to not be spending so much money, which is crazy to think about, or maybe get more people laid off and have the unemployment not so low.
Remember when everyone was talking about soft landing?
Yeah.
The reason why they were having that conversation is because the Fed jacked up interest rates really suddenly from roughly 0 to 5.5%.
And it worked.
That has an impact on people's consumption because debt is much more expensive. So again,
it's worked.
Hard to buy a house, harder to buy a car. Anything you need to finance gets much harder. It took a long time for this to work its way through the economy, but I think we're finally seeing it now.
I think that's exactly right. I think we're here when you see that 3 handle, like, does it go down? You know, what's very interesting about the 2% target. I went down the rabbit hole to try to figure out that 2% target. Like, I was like, who came up with 2% as a number? Like, why isn't it 3 or 2.5 or 1.5 or 1? It's a guy in New Zealand who was, came up with what he thought was a good target, 2%. The world adopted it. So
going back to our conversation about experts.
Yeah. And he just freely admits it. He's just like, yeah, I just thought 3% seemed like the right number. It wasn't too high, wasn't too low. And it's kind of healthy to have things go up in price because that means like the economy's growing. It's just a random target, 2%. It was his gut. Incredible, right?
Incredible.
Yeah. I mean, if you look at this, we are at, 3.6% annualized CPI inflation and 1.3% annualized GDP growth and a 4.7% 30-year treasury yield. This is, I don't know what else is more definitional of stagflation. The economy is not growing, prices are going up, and the cost to borrow has gone through the roof.
Yeah, someone's got to give. And then also, if they keep raising taxes,
well, it's giving.
Like their plans are, then affluent people are going to be trying to protect their assets. And
who's they?
I'm just thinking like a politician. Like if a politician were to raise taxes dramatically.
But which
I'm not picking anybody. I don't want you to have Biden derangement syndrome here, Sachs. Okay?
Well, I can promise you this. I don't think Trump's going to raise taxes, but Biden will if he has the trifecta.
Absolutely. Absolutely. That's why I'll see you Thursday night with my $50,000 check. I can't wait to be there. Yeah, it's going to easily be paid for by my tax cut.
Just to jump back for a second on the Salesforce point. So, Salesforce faces these challenges, but it's still led by Mark Benioff.
Absolutely. That dude's tremendous.
And if you look at the performance of the average public company, regardless of the sector that business operates in, that is run by a hired CEO versus run by a founder CEO.
Yeah.
The founder public companies that have gone public, achieved a $10 billion market cap, and are still founder run as the CEO from there, outperform nearly any index you look at.
Okay.
And this is, I think, like a really key point. You could probably put together, I think some people have done this, put together a founder portfolio, but I wouldn't count out Benioff just because of some of the stuff that we talked about.
That's my view.
Because founders can and will maneuver their way to success. That is the hunger of the entrepreneur.
Let's do our draft. The one founders you should not bet against. Which founder would you least want to short? Chamath, you're first in the draft. Who do you got? Who would you not want to bet against? Worst person to bet against.
Sorry, what do you mean? Like founders?
Any entrepreneur in history.
We already know what happened when people tried to short Elon. They got incinerated.
Barbecue sauce. Okay, you picked Elon in the draft then. That's number one. Chamath, who you got?
Yeah, no, that's easy. I would pick him too.
Okay, but we got to pick somebody else. That's why it's a draft. He already took Elon. I got to take the next person. It could be anybody. It doesn't have to be alive. Doesn't have to be in position right now.
Who would I? Sorry, what
Who
founder
would you
would I
least likely to short? An entrepreneur you would least want to short.
Well,
You have
Larry
Elon. He took
Larry
Elon.
Ellison.
Okay,
Ellison.
Larson's yours. Hold on. Now, Freeberg, you get to go in the draft. Who do you got?
I don't know I mean, all these founders, I don't know how to pick one. I mean, what are you
I'm going to
you're
go
asking?
with. I'm going to go with. I'm going to go with Bill Gates.
What? He's
That
not
guy
a
was dogging
CEO
his
of anything.
prime. No,
What?
I said it could be any period of
Well,
time.
yeah, now that you know the stock performance, what are you talking about?
I just think even in the next company, in
So
his
your
prime,
position
Jobs.
your
Steve
position,
Jobs.
hold on. You're going to go out on a limb. You're going
I'm
to go
going
out
on
on
a
a
limb.
limb and
Yeah.
say that
Yes.
when Bill
I
Gates
wouldn't
was
bet
doing his
against
legendary
Gates.
run, I wouldn't have shorted it.
Absolutely. I also wouldn't short Michael Jordan or LeBron James. Steph Curry, definitely wouldn't bet against him.